Welcome to the TSP Weekly Podcast.
Alrighty. Man, we are almost done with the month. What a month it has been. First quarter. It's been a crazy first quarter.
Yeah.
Yeah. So we have the new models and things that we've put out over the last few weeks, and one of them is a long-term model. Right?
Yeah, I don't know how many people watching the show. I mean, it's different, right? If you're not a member, you might not know, but check our website. We changed our whole website. It's completely revamped. We just finally did the public pages, meaning like the homepage and stuff, but all the internal stuff. We have like 60 courses now, or 60 lessons. There's like 7 courses. All this educational content on how to manage your TSP. And as part of that, what we decided, I don't know, a year or so ago, was basically there's only a handful of, because of the rules and restrictions within the TSP. Like there's only so many methodology strategies that you really can use, right? You got active, you got passive. Passive, that's buy and hold L funds. This is a quick little, right? Buy and hold L funds. Okay, let's set that over there. That's pretty much passive investing. Yep. If you're actively investing, when you look at the whole world of possibilities of what you could do, we really come down to like four models that work for the TSP. Short-term trend trading, long-term trend trading, seasonal trading, and swing trading. Now, you can argue variations of those. There's 1,000 hybrid versions, okay? Just set that over to the side. There's pretty much no other way, because of the rules and the regulations and all, and the restrictions, that you can really manage it. And so we kind of narrowed it down to that, and we created these model portfolios and these strategies, and basically help you kind of like figure out which one works for you. Because some people don't want to manage it on a short-term basis, meaning short-term would be like daily, weekly kind of thing. Long-term is more like monthly, a little weekly, monthly kind of, so it's a little farther out, meaning you're not doing as many moves. Right. You might do 2 or 3 moves a year, 4 moves, right? Yep. And seasonal is kind of the same way, but it's using seasonality instead of a seasonal trend versus like just a regular market trend.
The price is doing,
Yeah, and then swing trading is a whole other thing. Probably not the best use in very good for using in the mutual fund window. Yep. But not, it's kind of hard in the actual TSP funds, but it can be done. And so anyway, we've added all that to our website. If you're interested in that stuff, go check it out, growmytsp.com, and you'll see a little link at the top that says TSP courses. You can go into them to a certain extent. There is a free course that really lays all this out. The other one, of course, all the other ones are for members. But anyway, check it out. growmytsp.com/free course will get you the one that can just, it's basically we took our ebook, we completely revised it, and then made it a course instead of just a little PDF. So pretty cool stuff. But that's good. That's what Jerry's kind of talking about.
So it's the end of the month. It would be better for me if the month ended on Friday instead of Monday, just because I can do an actual monthly chart.
Yeah.
But as of noon here on Friday, the 28th, the S&P is down 1.5% for the day, but for the month it's down pretty significantly, and it's below. We use the 10-month moving average line and the stochastic indicator at the bottom for the long-term monthly model. And so there will be, it's significant. The monthly moves don't happen very often, and when you draw, lines to decide whether or not it's significant or not, that this closing March could be pretty significant. So, and the way you want to do it is look at the monthly charts, and if you're in a monthly uptrend, you're basically in a bull market. Then you go down to the weekly and you say, okay, if I'm in a bull market, there's going to be some volatility on a weekly basis in the long-term monthly uptrend. So if you want to play in there, you can do that. And then within the weekly, you can do the daily, right? That's how you do it. You kind of go from a big down to a small. If the long-term trend, the monthly trend changes, and you are trying to figure out when to get into the stock funds on a monthly downtrend,
you're working against the stream.
You're swimming against the current.
Yeah, because the current is now going bearish. Yeah. I think that's one of the hardest things to get people to kind of visualize is this idea of the longer trend. The longer trend, everybody says the market always goes up. And, when you look at long trends, decades.
Sure.
Oh, yes, absolutely. But not daily, weekly, and sometimes not monthly. And once these big trends change, you got to pay attention.
Yeah. I mean, we talk about this stuff all the time, and for me, it always comes down to the long-term trend change of interest rates. But all right, it's quite a few things to talk about. Actually, we're going to talk about how to look at a trend in the charts as we go forward. But so what happened this week? Evaluating a trend. How do we do it? How do we use Fibonacci retracements to kind of help us see to help us evaluate the trend? And then the seasonality hasn't changed. I mean, we're in a good time of the year that we should expect a rally, but price is not doing it. And then the TSP fund charts. So Monday we get global composite PMI. So composite, right? We talk about it's a combination of manufacturing and services. So anything above 50, the economy is expanding. Anything below 50, it's contracting. And you only have those two components, so it's a pretty simple metric. The composite rose to 53.5 from 51.6, which is good, right? Services was the whole piece. So it was up to 54.3, but manufacturing fell to 49.8, which is basically because of tariffs. And again, anything above 50 is expansionary for either or the combination. And the S&P was up 1.76% on Monday. And Tuesday, we got the Case-Shiller home price year over year. So the Case-Shiller home price index year over year was up 4.7%. So depending on which part of the country you're in, Boston, New York were up, Florida was down. So it just depends on what part of the country you're in. But overall, nationally, it was up 4.7%. So it's up for the fourth consecutive month. Consumer confidence dropped big time. From 100.1 to 92.9, so that was a big draw on the market this week for sure. S&P was down 0.16% on Tuesday. Wednesday, we got mortgage rates dropping a little bit, 6.71 from 6.72 last week. New applications were also down, so interest rates are still really affecting people. S&P was down 1.12% on Wednesday, and then Thursday we had GDP growth rate. So this was quarter over quarter, which is important because a recession is defined by two consecutive negative GDP quarters. And so for the quarter that ended, end of 2024 was 2.4% versus 3.1% in Q3. So growth rate was down a little bit versus the third quarter in 2024. And then this is what it looked like. So this is why I kind of want to do this. This is the 5-year GDP. So this was COVID, right? Obviously, GDP crashed because we weren't producing anything. Nobody was. And then it came right back up, right, when we pumped all that stimulus in right after COVID. And then it kind of stabilized all the way through. This was the talk about, were we in a recession or were we not in 2022? We had that first quarter was negative, but the second quarter was slightly positive on the revised numbers. So they didn't come out and say we had a recession in 2022. And all the way along, it's been relatively stable, right? We don't have really big growth happening, but it's been pretty stable, which is a positive. If we get right now, the forecast is for negative 1.8 for the first quarter of 2025. So that's going to be a big deal when that comes out. So definitely keep an eye out for that. Continuing claims rose from 1859 last week, whatever. S&P was down a little bit. Friday, this was a big one that everybody was looking at for Friday. The core PCE, which is the Fed's kind of preferred inflation index, it's personal consumption expenditure. It rose 0.4% in February versus rising 0.3% in January. None of these seem to be that big a deal. The biggest thing is when it's really contrary to what the analysts expected. And they expected a 0.3 rise in February, and they got a 0.4 rise. So inflation is still a problem, right? That's the bottom line. But personal income and personal spending both rose, which is good. It means the consumer is still spending, but inflation is ticking higher. So this is what that kind of looks like, right? This is a 10-year of core PCE. So this is normal, right? This is when inflation is just oscillating between 0 and 0.2. So it's not going up very much, right? That's kind of what we want. It's stable. Inflation obviously drops in COVID because no one's buying anything. It's deflationary, right? Prices are actually going down. And then it rips up. And so we have all these quarters, throughout here. Cumulatively, this goes up, which is what got us to 9% inflation back here at the peak finally in 2022. And then it started coming down, right? The problem is this. We bottomed for a while, and now we're accelerating to the upside on inflation. And so if this continues up over time, because it's cumulative, inflation, becomes a problem again. And it's cumulative. So we're up like 25% at least since before COVID. So prices are significantly higher. And then you add that inflation to those prices that are already high, and it just gets worse for consumers. Okay, so how do we evaluate a trend? There's a lot of angst out there right now about volatility in the market. It goes up one day, down the next day, and sometimes those up days matter, and sometimes the down days matter. And so this is just to kind of give you guys an idea of how to create the guidelines. So this is a daily chart of the S&P 500 RC fund, right? These down periods, right? People get a little bit freaked out about it, but it's not that big a deal. When it becomes a problem when you have a move down and then the recovery does not go to new highs. So all the way along here in 2021, you have pullbacks, they go to new highs. Pullback, new high, pullback, new high, right? All the way along, that's what you get. The problem becomes when you have a pullback and you do not go to a new high. You go to some percentage, you've recovered some percent of this, but then it goes down again and undercuts this low and goes to a new low. Because now you have a defined downtrend. And then on the next recovery, you still couldn't get back to new highs. And it rolls over and gets below that low, right? So that's the definition of a downtrend. So you don't really worry about the pullbacks. It's really what happens after the pullback that matters. So where we are right now, we had this big 10% correction, right? Every other time back here, you get these pullbacks, you get some kind of recovery rally, a little pullback, and then it keeps going to new highs, right? Correction, a pullback, or a correction, a recovery. You didn't get to new highs here, but when you rolled over, you stayed above that low, and it went on to new highs. So you can't really evaluate. You don't know how long the initial correction is going to be. What matters is what happens next and after that, right? So where we are right now, this is as of Wednesday, so who knows what's going to happen by the end of the day. We're going to be down here somewhere probably, but we had that initial move down, and we're looking for a recovery. And then if we get a little pullback from the recovery, that's fine as long as it stays above that low, because then we can keep going higher. So this is their decision points. This is like the times when you try to make decisions. So if you look at it on a weekly basis, right? We talk about this all the time. The divergence between price, when price is going up and relative strength is going down, that's a problem. That's what led us into the 2022 bear market. And that's kind of where we are now. We've been talking about it for months. Price has been moving higher since this peak, November last year. We still get higher highs in price, but we're getting lower highs in relative strength. So it means the momentum of that upward move in price is decreasing. It's not a timing tool. It's an alert flag kind of. And then the market rolled over. So now the 50 relative strength line becomes really important. So you can see kind of back here, whenever, it can undercut it a little bit, but basically it's getting support at that 50 line whenever we get these pullbacks, and it keeps going to new highs. But whenever price stays below that 50 line, right, that's when you have problems. So we had that first pullback, and now it looks like we're hitting resistance at that 50 line. So the longer we stay below that 50 line on relative strength, the longer we have this decline in price. And then one of the easiest ways to do it is just look at the 200-day moving average line. So we're back to a daily chart. The purple line is the 200-day moving average line. As long as you're above the 200-day, everything's good. If you're below the 200-day, that's when you don't want to be in the stock funds when you're below the 200-day. And we are right on it right now. We undercut it a little bit here. We did a recovery for the last 2 weeks, and now we're right on it. So this is a decision point. Not that you would try to guess what's going to happen next, that you would let price tell you. If it breaks above, if it finds support here and breaks above it, that's a good time to get back in. If it breaks down, and certainly if it gets below this low, you don't want to be in the stock funds. I mean, this is a long-term game that we're playing. One easy way to do it is just say, okay, I'm going to be in the stock funds when when the S&P 500 is above its 200-day moving average. And it could be as simple as that. Okay, so Fibonacci retracements. We talk about Fibonacci retracements all the time, and what it's good for in a declining market is to tell us where these recovery rallies will hit. And if they hit these Fibonacci retracement levels and roll over, it likely means the market keeps going lower. So this is 2022, right? We're at the top in 2022 right here, or, the end of 2021, beginning of 22. We had that first move down, which is very similar to what we have right now. We had a recovery rally that hit the sweet spot right between that 38% and 62% retracement levels, right? It's called the golden ratio. This is like the sweet spot right there. Anywhere in here, if we can get past that, we're likely to keep going higher. If we can't get past that and it rolls over, it likely does another leg down, right? So that's what happened here. We had the first move down, did the recovery rally, couldn't get out of the resistance at that golden ratio, rolled over and came back down for another leg lower, right? The next one, if this one was a longer move down, right? We got above it a little bit and then rolled over, right? So it matters if you're looking at, this was the first big move down, and this is the recovery rally. This is the second big move down, but part of the first, and you have this recovery rally. Once it gets below the prior low, it goes down again. I mean, the Fibonacci levels are really, really helpful. And this was the last one. We had the last big move down into that June low in 2022, recovered just barely to that 38% retracement level, and then another leg down. So this is where we are as of Wednesday. And as of Friday, we're probably going to be down here somewhere. But we got just barely into that sweet spot, right? We got just above that 38% retracement level, and the market rolled over again. So that's why when you're looking at it and you're going, okay, this day right here, there was a lot of talk on Facebook about, see, this is why you want to stay in the stock funds, because you're gonna miss those up days, and that's true. You would miss that up day. But if you're looking at the Fibonacci retracement levels and you're going, okay, where do I expect, if this thing's going to roll over, where do I expect it to roll over? It's going to be somewhere in here. And the earlier, to roll over at the 38% retracement level is not, it's a bearish sign. If we get below this low, the market keeps going down. Okay. So that's all negative, right? Price action is negative right now. There's no doubt about it. From a seasonal perspective, though, this is the average of all years. Okay, going back to 1950, I think it is. And this is the current S&P 500. So you would expect a rally into the summer, and then you consolidate during the summer, and then you rally again in the fourth quarter, right? That's historically what happens. And so if you have a big pullback into March, that's historically a great buying opportunity. It's just that right now, price is not telling us that it's not acting as what you would expect in seasonality, because by now we should be seeing the beginnings of a recovery rally, and we're just not seeing it yet. And the other way to look at it was Almanac Trader, and it's basically the same thing, except it's a little bit more detailed because the black line is all post-election years. So we're in a post-election year. The purple line is when the incumbent party loses, right? So this is really specific to this election cycle. And this is the average of all post-election years when the incumbent party loses since 1949. So again, you would expect a rally in March into the summer, right? And then we get a pullback into the fourth quarter, and then we get a big rally in the fourth quarter. So going forward, maybe we get that. But right now, I mean, price is continuing down. So seasonally, you're looking for a recovery rally. It's just that price isn't giving it to us yet. Okay. TSP stock funds. So this is a weekly chart of the C fund where each tick here is 1 week of price action. And this is the 20-week moving average line and the relative strength indicator. So as long as we're above and finding support on the pullbacks at that 20-week moving average line, everything is great. As soon as you get below that 20-week, it doesn't mean you're going to get, the 2022 bear market, but the possibility increases significantly, okay? We keep getting pullbacks to it and finding support there. That's all good. But for the last several weeks, we've been below that 20-week moving average line. So once you're below there, this was like a month ago. Once you're below that on a weekly basis, the risk is much higher that prices go down than what you would lose if they go up. Because once you get back above the 20-week, you just get back in. And again, that 50 relative strength line is really important, because as long as price is above relative strength of 50, price is going up, right? When it's below that 50 line, price is going down. So you don't have to make it very complicated. S fund, it's just collapsing. It's a waterfall. The worst thing about the S fund, to be honest, we had a slight higher high from where it was in 2021. Then we have this 1, 2, 3, 4, and the next move down should be the 5 wave to complete this first wave down in the S fund. It certainly looks like the next move is down for the S fund. This black candle, it means that price opened the week up here and closed the week down here. Now this is as of Thursday's close, but it's a reversal candle. It's negative. It's not good. iFund, again, still holding up better. It's not great, but it's holding up. It's holding up better than the other stock funds are. I don't know that the iFund is worth being in the if the U.S. goes into recession, the rest of the world does too. So we shall see. F fund can be a great alternative if everything rolls over. In the absence of everything rolling over, with the fear and uncertainty that's in the market right now, the G fund is really the only place to be, because the G fund always goes up and to the right. As rates come down, if they do, the F fund will go up, and the rate of return for the G fund comes down. So, it depends on how all this stuff plays out. But again, you have no risk to your principal in the G fund. Questions?
As always, if you have questions, put them in the comment section wherever you find the video. No comment section, just shoot us an email. If you have a question, our support team will get it over to us, support@growmytsp.com. And a lot of good stuff in there. You know, if you missed the first part we were talking about, and then kind of put that in perspective to the charts that Jerry just showed you, you know, we're in a very different time right now. Yep. And I mean, we've seen it before because we've been doing this for a long time. But most people that haven't been paying attention to the market, like hopefully you are, if you're watching this show, you know, if you backed up 30 years, you might not have been paying attention back then. But this is a cycle that we go through. You know, the market does not always go up. No. It does corrections, and then it normally goes up again. You know, we're not talking about a stock market crash. Right. We're just talking about a correction. It happens. It's a bear cycle. But pay attention. Now's the time not to take your eyes off of it. And again, if you want to learn more about how to do this stuff, growmytsp.com/free course. We got a good course on helping you manage your TSP. All right, guys, have a great week, and we will see you soon.